Okay, thank you very much for inviting me to speak today. Just a little bit of background. I'm David Yermack. I teach in the finance department at NYU Stern, and my perspective on this material is very much that of an economist because that's how I'm trained. I also have a law background, and so I teach a blockchain course that has a fair amount of regulation built into it as, part of what we cover. I'm not a computer scientist or an engineer, but I know enough to fake it. And I welcome questions of any type. People should feel free to interrupt. And the caveat I always give is that this is very new material and that, many different points of view are probably welcome and, lots of room for disagreement. So I want to talk about the Ethereum merge, which, was really one of the iconic events in blockchain history, such as it is. This took place a little over a year and a half ago in September of 2022. And the basic goal was to change the consensus protocol on Ethereum from proof of work to proof of stake. And we'll talk more about this, but the point I want to make over the next 45 minutes or so is that there's been a lot of unintended consequences, that despite the really impressive technical achievement of pulling this off, I think there were things that some of them they should have thought of, some of them were probably impossible to think of. But the question I just want to ask is if the Ethereum Foundation had another shot at this, could reconsider it, would they still want to make the switch? Would they want to move from proof of work to proof of stake? And I'm not so sure that the answer is yes. They're not ever going to admit this, of course. But I think, there's enough concerns that have arisen over the last year, year and a half, that we need to look at this, very carefully, and particularly for other projects that may ever try to migrate their consensus. There are some issues here that should certainly be top of mind. So what I want to do, I'm actually going to change my screen share for a moment, and let me switch to a website that is live right now. And what this shows is a block being built on Ethereum. And these blocks are exactly 12 seconds apart because that's the way the consensus mechanism works. And what you watch every 12 seconds is that a group of people called builders are making bids, basically offering up a set of transactions to the validator who has the privilege of actually mining the block or writing the block to the blockchain. And so this is, really the first thing that I'm not sure was completely expected is that the validator here doesn't really do any work in terms of bundling transactions and so forth, the way that a Bitcoin miner would, and the way an Ethereum miner would have done before the merge. Instead, there's what is called proposer-builder separation, and these builders troll the memory pool of the blockchain, and they also have private transactions that are known only to them. But essentially, these transactions, if they are arranged in the optimal way, take a lot of value out of the pocket of the traders and the customers on Ethereum. This is, of course, called MEV, or miner extractable value. And these people who are putting in bids every 12 seconds are offering essentially to split the gains with the validator, who for 12 seconds is a monopolist. And this is just totally different than proof of work. Under proof of work, it was also a target 12-second interval. So the work occurred, roughly at the same speed as it does here in terms of adding blocks. But the miner had much more to do. And the miner never knew until the end of the interval whether they actually would win the block. Miners were competing. In fact, thousands of miners would be competing head to head. And for any one block, they probably thought it's not likely to be me. But here, essentially, you're designated in advance that you've already won the block and you have 12 seconds to take the biggest bribe from one of these builders. And it's more complicated than that because the builders, in turn, are getting blocks proposed by relays who themselves are reaching back. There's a whole value chain of people here who are doing the work of figuring out how to rip off the customers in the most outrageous way. And I think one of the problems you need to worry about is that this has become such a bad deal for the customers on the decentralized exchanges and so forth that they're not going to want to stay on Ethereum. That, there's other blockchains out there that have different consensus protocols. And the deck is stacked against you here, to an extent that you're going to start looking around. If there was one airline that was overcharging you for every trip, you'd look to travel on another airline. And I think Ethereum has, essentially given so much power to the validators here that the deck is stacked on every hand against people looking to trade. So I want to talk more about this, but it's fun to watch this website. I mean, it's a little bit addictive, but you can see every 12 seconds there's an auction. And whoever has, the best deal for the validator is going to, grab the prize here. So let me go back to my slide deck.
Can I ask a question?
Yeah, go right ahead.
Just to kind of clarify and simplify. So I think like many times when people compare between proof of work and proof of stake, they compare between Bitcoin and Ethereum these days. But when you speak about MEV, I think like it's kind of complicated to do it because in Bitcoin there is no like DeFi and DEX activity, so MEV is not really a big deal.
Right.
So here, basically, the idea about moving from proof of stake to proof of work to proof of stake in Ethereum, you say like it's generate kind of a gap in time that give kind of certainty to the validator that they can generate an auction, while in proof of work, there is no time to generate an auction because you have uncertainty.
I think that's exactly right. There's really two issues here. One is that the uncertainty is quite extreme, that you think it's probably not going to be me. It's like you're hoping to win a lottery, but most of the time you're not going to have the winning ticket. And then the other is that you're busy doing proof of work, actually doing the work. And here you've got 12 seconds, which in computer world is a long time. And you can actually run an auction. There's other research circulating that shows that these auctions typically take 2 to 3 seconds. People don't use the whole 12 seconds because there's other things that need to occur. And if you take too long, you miss your block, you miss your slot. So you have to be very careful not to let the auction spill over. But still, you have plenty of time. And one of the things that you can do is be a little bit strategic, that if you know who has the next block, you can collude. Like I'll take this one if you take the next one. And, between the two of us, the sequencing of the transactions is profoundly valuable. And you have opportunities here to plan ahead, to communicate and so forth that simply didn't exist under the old system. So we did have MEV before the merge. And the first question you really want to think about is the problem worse now? Or, is it even a problem? And, I want to talk about both of these things, but it's, I think it's unlikely to be unaffected, is one way to put it, that there's probably things that have changed here. And my sense is that it's probably not in favor of the customer who you ultimately need to sustain the system.
And a follow-up question, if we think about this in the other direction in terms of Bitcoin, so in Bitcoin, in a world that, let's say, DeFi is not, MEV is not really meaningful, do you think that moving from proof of work to proof of stake in the Bitcoin blockchain, it's also going to generate problem, or it's less?
I think there are definitely some other problems that I want to talk about, and the staking in particular has, I think, it is something that no one expected to be as one-sided as it has turned out to be. So I think if Bitcoin, it's hard for me to imagine that Bitcoin could ever make this transition simply because it's so decentralized. There's really no leadership of Bitcoin in the way that Ethereum has Vitalik and the foundation and a very active set of developer conferences. And that they're going to do major upgrades to the system every 12 or 18 months. It's not like that with Bitcoin. And you really would need something that was incentive compatible for all the current miners. And as we'll talk about, the merge here really expropriated the old miners on Ethereum. That was very, very bad for them. And I think for that reason, you would never get the kind of support you would need organically on Bitcoin to make this transition. I think, though, that there's a bigger point that proof of work is very secure. It's really proven itself over 15 years. And if I were a big holder of Bitcoin, I would, be very reluctant to see my investment exposed to the risk of a new protocol. I think that, people underestimate the benefits of proof of work. And while it does use a lot of energy, nevertheless, it's the most secure cyber system that's ever been developed. And you're taking a lot of chances with the foundation of the system when you make this move. And I just see no business reason for Bitcoin, if it did have leadership, to even contemplate changing what has been a very successful business model. But, the essential difference is that Bitcoin has only one token, which is the Bitcoin. Ethereum allows you to trade thousands of tokens on these decentralized exchanges. And where the MEV comes from is really those other assets. It's not the Ether coins, but the fact that you've got all these additional assets that attach very easily to Ethereum. But if you execute those trades in a certain sequence, it would be just like being front run on Wall Street. If your order book was exposed to people who could then rearrange it in advance. So let me get into a little more of the details about proof of work versus proof of stake. This is a little cartoon that I use in my MBA class. Proof of work, it's, I think, summarized pretty nicely in the top left graph or the top left box. Essentially, if you have 1% of the hash rate on the Bitcoin network, you're going to win 1% of the blocks in the long run. It's like a lottery where one CPU equals one vote, and the number of votes is the total CPU. And essentially, it's a brute force algorithm where the more resources you invest, the more likely you are to win. Now, proof of stake on the right, in its pure form, is meant to replace the work with simply a lottery, and it's a lottery that is weighted by your stake in the system. So if you owned 1% of the Ether coins, and that's one way to think about the stake, is just percentage ownership. If you owned 1% of the coins, you would win 1% of the blocks over a long period of time. So in that sense, these are actually very similar algorithms because the chance of winning is proportional to your investment. On the left, it's the investment in CPUs. On the right, it's your investment of the underlying asset. But it's more complicated than that. And to begin with, the stake can be reconceptualized in a number of ways. Rather than just percent ownership, other blockchains have had the weighted average by time. So time, long-term holders, essentially the duration of your ownership times the number of coins. You could also think of the stake as your throughput, the number of transactions or the amount of spending. So the flow rather than the stock. And I think, these are interesting trade-offs. What most projects have done, though, is to go with a somewhat hybrid model that is called delegated proof of stake. So not everybody on the blockchain is participating in the lottery. It's only a minority of major holders who opt into it. And the right to be in the lottery and to perhaps become a validator is chosen within this subgroup. And the people in the subgroup, sometimes they have to get elected, sometimes they have to buy in at a certain table stake, which is the case with Ethereum. But there's all kinds of ways to design this. The basic point, though, is that you don't want it to be predictable who's going to win, because if someone knows in advance that they're going to get to mine the block, they can make plans and they can, essentially think of ways to scheme against the transaction creators who they're going to be validating. And the other thing is that both of these require an investment, and that the investment is what we would call bonding in economics, that you would invest in hardware on the left, and you would invest in ownership on the right. But your willingness to invest shows a commitment to the system. And if you were to misbehave or cheat or somehow subvert the system, the value of your own investment would be probably forfeit. And so the stake sort of guarantees good behavior by whether it's the proof of work miner on the left or the owner who's a proof of stake validator on the right. So that's the basic idea. And let's just talk about how the transition occurred from proof of work to proof of stake. So this is a little diagram, and it shows the proof of work legacy blockchain, the original blockchain of Ethereum, in blue on the bottom. And this had been running for almost 8 years. The Ethereum project had launched in 2015. And from the earliest days, they actually had indicated that they were going to eventually transition to proof of stake. But that transition was subject to a lot of beta testing, and it was postponed several times. But eventually, a dry run, a trial blockchain called the Beacon chain that would replicate the regular Ethereum, but using proof of stake. This was launched and was essentially debugged and shaken down to to participate in this. You actually had to put some real ether into escrow, and the amount of ether that was locked up in the beta test of the Beacon chain was about $20 billion. I mean, this was an extraordinarily expensive software test, and I think by far the most expensive beta test ever. But after a couple of years and a couple of postponements, the day arrived in September of 22. And there was the interesting question about how to get everyone to move from the blue chain to the red chain. And so Vitalik and the Ethereum team had planned for this. And there was a certain block where there was a so-called difficulty bomb planted in it. So what was meant by this is that in proof of work mining, I think, as people probably know, in Bitcoin, the difficulty adjusts every 2 weeks to make it a 10-minute problem. And with Ethereum, the adjustment was actually continuous. It was simply reset every block based on the 3 most recent blocks to make it a problem that should take about 12 seconds as opposed to 10 minutes. So it was 50 times faster than Bitcoin, but still there was a target duration. Now, what the difficulty bomb did was take the expected work from 12 seconds of work to like 12,000 years, or just some incredibly lengthy amount of time. It was like a bomb going off. So the word to the proof of work miners is you can keep proof of work mining if you want, but it's going to take you centuries to get even the next block. And so you all but had to abandon the proof of work mining and jump over to the other chain where the proof of stake was in progress. It's really a pretty cool idea to coerce people into making the switch. And one thing this did was expropriate the value of all the hardware on the proof of work blockchain. All these people had made investments in specialized hardware and so forth, and they all kind of knew that in the middle of September of 2022, it was suddenly going to become worthless. And so I had actually expected more resistance, and there was talk of boycotts of the miners on Ethereum going on strike. And one thing they tried to do, which I think was a clever idea, was they put in a hard fork on Ethereum 1 block before the difficulty bomb. So, if you didn't believe in proof of stake, you could take their hard fork and just continue with the old proof of work. And if enough people had done this, the proof of stake never would have gone live. But none of this got people's attention. That fake Ethereum, fork 1 block before, that chain is still out there. I forget what it's called. And I think it's, maybe a nice insurance policy. If this thing hadn't worked, you could revert to that. But what the miners on Ethereum ended up doing was they all went to Ethereum Classic, because, this was the old DAO fork that had occurred back in, I guess it was 2017. And the Ethereum Classic project never moved to proof of stake. And the mining is the same as it had been on Ethereum, of course. So this was actually a shot in the arm for ETC, the Ethereum Classic coins. They suddenly inherited all the mining capacity of Ethereum, but of ETH. But, there are many other issues with that project and so forth. So this was very interesting that they pulled it off so seamlessly. And people compared it to changing the engine in an aircraft while the plane was in flight. And there were watch parties on the internet and so forth, people watching the blocks count down. But I think you have to give them just a lot of kudos for making this happen without any real problems at all, in the moment. That as a feat of software engineering, this is really pretty impressive. So how does it look now? With the current configuration of Ethereum, you have blocks that are still 12 seconds apart, and that's the video that we were watching at the start of the talk a few minutes ago. And these blocks are arranged into units of time called an epoch. And an epoch is 32 slots. When we talk about epochs in history, it's like the age of the dinosaurs or, the Roman Empire, it's talking about very long periods of time. But here, an epoch is 32 times 12 seconds. It's 6 minutes and 24 seconds. And then there's a new epoch begins. So in each epoch, there is a delegation of the authority to validate to a group of 128 people who have to stake 32 ether each to be considered. So you're chosen from among those eligible, and then within that group of 128, each of the 32 slots will then be assigned randomly. So, 25% of the people in the community of validators will get to mine one block. And if you're too slow, the slot is simply unfilled and there's no blocks. You have to do it within the 12 seconds. And the other people who are not validating a given block are assigned essentially to watch you and make sure that you don't misbehave. And, this is a little bit beyond the scope of the talk, but there are things that you can do to fork the blockchain or sabotage the blockchain. But if you do those things, the other 127 people can call a penalty on you, which is called slashing, just like in hockey. And you get a bounty if you call a penalty on somebody and you're correct. But ultimately, each block has to be approved by vote. So this group of 127 people, not only can they call penalties, but they have to vote 2/3 in favor before the block counts. So it's a very interesting system of incentives and monitoring. It's worked extraordinarily well. There's been the amount of penalties called on people and the amount of empty blocks is very, very low. I mean, people really do the jobs that are assigned to them, and the incentives seem to be set up such that you don't see a lot of misbehavior or attempts to cheat. So again, just as an economist, you have to admire the thought that went into this. And I think, the years of delays and so forth were for a reason, which was to get these incentives, pretty much lined up the way that you would want them to be.
Can I ask a question?
Please go ahead.
Can you go back?
Yep.
So in order to be to stake, you need to deposit
32 ether.
32 ether. So when you say, like, when they pick the 128 validators, it's one of the each deposit, right? Because if there is a big staking pool, they have many slots, but only one of them can be.
Okay. Well, this is what we're going to come to, is there are now these staking services. And I think if you talk about, for instance, Lido, which is by far the biggest, they're just going to subdivide their holdings into units of 32 blocks.
Okay.
So, it's like the Indianapolis 500. There's room for 33 cars on the grid. And if somebody owned 15 of the 33 cars, you'd start to wonder about the nature of the race. But that's exactly what's going on here. So, you can, let's get to these staking points in a moment. But this is a big difference from pure proof of stake, because if I own 40% of the coins, I would get 40% of the blocks, but here you subdivide it into stakes of 32. And that leads to, somewhat different arrangement of the incentives to both behave well and take care, but also the incentives to participate. So I think this should be obvious, but the goal of the merge was to cut the energy use. And this was a very early paper. After the first few months, they looked at in the top how much of the energy use declined on Ethereum, and it declined by like 99.9%. If the goal was to save all the energy from proof of work, that definitely was implemented. And so if you're worried about cryptocurrency, heating the planet, destroying the way of life that we all know, this is, one for the good guys. You slow down the burn of fossil fuels or whatever. And the graph on the bottom is the transaction count, and it shows that essentially before and after the merge, very little difference. That you accomplish this 99% reduction in energy and still maintain the same level of throughput, the same number of people using the chain and so forth. So in that sense, it was a very successful change. Now, here's the staking that's going on, and let's explain what this is. Not everybody has 32 Ether, because right now that would cost you about $100,000 at the current market price. But even if you only own, a tiny little bit, like $100 worth of Ether, you can contribute to a pool called a staking pool, where many other small investors will also toss in their Ether. And the goal of the pool sponsor is just to combine a lot of small investments into 32 Ether. And what these people will then do is enter the validation lottery, and they will eventually win some of the mining rewards. And those rewards will be paid out basically as a dividend to the stakers. So right now, 26% of all the Ether coins on the entire blockchain are in somebody's staking pool. It's an extraordinary amount that has been devoted to this. And the rate of return for staking is about 3% on an annualized basis. So if you put your Ether into a staking pool for 1 year, the yield would be 3%, which is sort of like the dividend on a stock, or the interest rate on a bond. You might think of this as an investment security, and in fact, the Securities and Exchange Commission thinks of it as a security. So there are going to be some legal issues with this staking that may take some time to resolve, but you get a rate of return which is 3%. You might think, I can do better with treasury bonds. You get maybe 5%. But the other thing you get is what's called a staking token, that you get a token that represents your ownership in the pool, and that's a liquid token that can be resold. And so you also get the capital gain, that if Ethereum goes up in price, you don't have to take your token back out of the pool. You can instead sell the surrogate token, the liquid staking token, and presumably that would go up at the same rate as the underlying escrowed Ether. Now, if you look at this chart, the staking ratio from the very start, as measured in the fourth quarter of 2022, was already 13%, and it's gone up monotonically. There's only 5 quarters of data on this graph, but it shows that the amount of staking has basically doubled over the first year and a half. And to me, this is just quite extraordinary. This would be like at the university if 26% of the students studied accounting and got their CPA, and a quarter of the economy was, basically devoted to keeping track of the other 74%. This is just way more record keeping than you need. Any economy where 26% of the people are just keeping track of things is probably not a very good economy. So I think, first of all, there's too much staking. And what the next slide shows is the market share of the major staking protocols. And look at the top two. Lido and Coinbase have almost half of the staking market just by themselves. And, the consolidation of this is in many ways more extreme than the mining pools that you see on Bitcoin. This has been an issue on Bitcoin, where you have these mining pools that draw in small amounts of CPU from people all over the world and then share the rewards if somebody wins a block. It's really the same kind of logic here, but you've got, I think, more concentration here than you see in the mining pool. And it seems to be getting more and more extreme with the passage of time. So whoever is running Lido is really very important. And, if they made a phone call to Vitalik, does Vitalik take the call? And who exactly is working for who is, I think, the question that you should be asking. But this is beyond people investing in a stake and then creating a reputation that they're going to do well because they are a big owner. This is really more like a monopoly, where someone's in a position, not only to call the shots, but to participate in future protocol changes, to suggest software changes. Just someone has a lot of power here. And this was not the point of going to proof of stake at all. That you didn't have anything like this in the old Ethereum, this kind of concentration of mining power. And now that we do, I think there are governance consequences that, in the long run are perhaps somewhat dangerous. So let's talk about MEV now. And MEV, when it was first discovered by his team of computer scientists led by Ari Jules at Cornell Tech, their academic paper was called Flash Boys 2.0. And I think it's really a milestone of blockchain research. But they point out that if you go into the mempool of Ethereum, rearrange the order of transactions in the way that's optimal for you. So here it's a very simple graph where there's just 4 transactions and the order is reversed. But when there are thousands of transactions, there's all kind of possibilities for the ways that you could stack the deck. But this is very similar to front running on a legitimate investment market. And front running, of course, is totally illegal. You could, it's a form of fraud for which you can get into big, big trouble on Wall Street. And it's amusing that if you go on ethereum.org, which is the website of the Ethereum Foundation, they talk about MEV as a form of front running. It's like, yeah, it's a form of securities fraud that occurs on our system every day. I mean, I'm surprised that they don't get lawyers who advise them to clean up their language a little bit, but they're very open about this. And the MEV is essentially the maximum value that can be extracted by a miner who arranges the transactions in the very best way. Now, we don't have miners anymore. We have validators. And rather than rename this VEV, it's just called maximum extractable value to preserve the initials MEV. But it's bad for the customer. And whether you are willing to tolerate this if you're a trader in a decentralized exchange is really, the heart of the issue. So the attempt to address this was already a well-known. Yeah, go ahead.
Can I ask a question?
Yes.
So, what's your point of view? Because there is some econ papers that try to kind of split MEV to bad MEV, which is kind of what you mentioned, but there is also something that people call good MEV. It's when the miner or validator doing arbitrage opportunities that have economical benefits in terms of clearing the market price and whatever. So
I think one of the very good things to come out of this is a reconsideration of the whole role of the market maker and whether front running is bad 100% of the time. So I was giving a very early version of this talk about 8 months ago down in Australia, and I condemned MEV. I said, this is terrible for the customer. And then a guy came out of the audience at the end of my talk, and he said, I'm a validator, and this is part of my compensation. The only reason I show up and do this every day is because I know I'm going to get my slice of the MEV. And because I get the MEV, the gas fees, the transaction fees are much lower, that I'm being compensated in a different way. But in the end, you're going to have a market equilibrium where the supply of, miners and the demand for validation somehow clear on a market fee. And I have to say that this guy asked a question that made me reconsider the whole thing. And it's a little bit different than the point you just brought up, but that this is essentially a reward for people who are doing a lot of work. And that it's not that they're just, vultures who are taking something away. They wouldn't even show up and, provide the infrastructure services for all this if they didn't get their piece of the pie. And the way this is regulated on Wall Street is through a commission system, but that rules out any favorable trading for the market maker. But that may not be optimal. And it may even be that the market maker can make the market more efficient by arbitraging things in a certain sequence. And this is great for academics because you can now, reopen this classical topic in market microstructure. And the technology has, made people reconsider something that was viewed, really for, I would say, hundreds of years as a settled issue. So I have a colleague, Joel Hasbrook, who's one of the, very important people in microstructure, and he's suddenly writing a lot of papers on this issue with Fahad Saleh, who spoke in your seminar just a few weeks ago. And they're doing some very interesting reconsideration of how this was done historically, how it's done now, what's good about it, what's bad about it. And I think, for those on the call looking for thesis topics, the appropriateness of MEV and whether it should exist at all, these are great research questions. You don't have to take a stance on this so much as try to evaluate it. One of the proposals that's now circulating to fix this, if you will, is to rebate the MEV back to the customers, to let, go ahead and exploit people all you want, but we're just going to confiscate it as part of the algorithm and then return it to all the people who traded. And that's another system. I'm not sure if it's a good idea or a bad idea. It probably helps some people, hurts others, but there's a lot of imagination being brought into evaluating this and thinking, how do we deal with it? And, I think there's no question that we'll know more about this in a year or two and that there's going to be some interesting work done. But I do think, just a high level view, when you look at this and you see, I don't have to put up with this if I trade on the legacy markets, but I do have to put up with this in the decentralized blockchain markets. This is something that you at least need to explain away to people. Like, why should you not be worried about this? So when the big merge occurred, it was understood that MEV was already an issue, if you will, or a problem. And so this thing called proposer builder separation was built into the design of Ethereum, such that the proposer, who's the little white block with the number 7 on the far right, would essentially obtain proposed blocks from relays, who would get them from builders, who would get them from searchers. If you go backwards to the left in this chain, the searchers are scouring the memory pool, the builders are putting blocks together, and so forth. So the little video that we were watching were relays, and they were at, step 5 of this thing, where they're proposing maximum profits and then offering to split the profit with the person who had the right to write the block. What's interesting about this is that is not just one public mempool, but each of these people can receive private transactions. Like, if you get a chance, add me to the block. And they can also add their own trades, that they can take in orders from customers and then stick their own trade at the end. So this is where you get your sandwich attacks and, various other things. And again, a little bit beyond the scope of what we're doing. But essentially, this was an attempt to rein in the block proposers, to in the belief that they wouldn't be able to see the transactions. You have some relay person saying you can make 3 ether if you take this block, but you don't know who it is that you're going to be taking advantage of. So this would get, it would avoid the problem of censorship and playing favorites and so forth. And in that sense, there was probably some logic to this. But what you've seen is, at each stage of this process, a huge amount of consolidation. And the most extreme is at the stage of the builders. There's a program called MEV Boost that, essentially optimizes the searching over the mempool. And you can see the market share of this thing. It was introduced at the time of the merge itself in the middle of September 22. And it took about a month and a half, but it quickly got up to about 90% market share. And, all of these builders who are the green boxes there, pretty much every one of them is running the same software here. So it really raises the question of, what's the settlement layer here? Is it the Ethereum protocol that is maintained in Switzerland by Vitalik? Or is it this MEV Boost thing, which we know much less about? And I think, this is just, it's so extreme that you really have to recognize that these people have essentially become partners of, the people running the protocol. And the idea that there would be competition at each stage of this blockchain or this block building process just doesn't really exist. You have a real monopoly here. And whether they have vulnerabilities, whether there are, hidden plans to steal value, it's just all kinds of nightmares that you could worry about. So you're seeing some interesting research. Again, this is I pulled two figures out of this paper. The one on the left shows that the MEV boost is relied on. In fact, it generates much more value in times of market instability. And the two red vertical bars, you can see they're labeled. One is the moment where FTX collapsed back in November of 22, and the other was the failure of Silicon Valley Bank, where you had the depegging of stablecoins very suddenly. People relied on MEV boost, especially during those moments, to help clear the market. On the right is a graph that shows the ratio between the regular gas fees, that's the transaction fees, and the amount of MEV taken by MEV boost. And just eyeballing it, it looks like the majority of the incentives are still basically from the gas fees, but there are definitely times where the MEV dominates. And these appear to be the times of market instability. So again, much more to be learned about this. And whether this is efficient or not, who can say? So I think I'm almost near the end of my time. Let me wrap up, but sort of recapitulate what the points I've tried to make. First of all, you don't really have proof of stake in anything like the form that was discussed when this was an abstract idea. The ability of small players to get in these mutual staking pools and the extreme size of the pools themselves have really subverted the whole process of staking, so that you have a very different incentive system than people probably imagined when this was drawn up on a white paper. The third point is that you have one program, this MEV boost, which is really the gatekeeper for an awful lot of the value created, even by trading. If you make a good trade in a DEX, it's really going to end up in somebody's MEV boost packet that is going to be then auctioned off to the validator and so forth. So the fourth point is really the heart of the issue, is that as an investor, is there a hidden cost of trading here that makes it really undesirable? And my gut feeling is it is, and what I base this on is that the total value locked on DeFi has really been dropping for the better part of 2 years. If you look at the high watermark was probably in the summer of 2022, before the collapse of Terra Luna and FTX and so forth. And it has gone back up, but to the extent it's gone back up, I think a lot of the total value locked today is in liquid staking. It's not in DEXs, it's not in MakerDAO or lending. I think the customers, the long and the short of it is that they are abandoning DeFi, that the organic amount of trading and lending is actually shrinking because they know they're getting ripped off by the validation process. I don't have a rigorous proof of this yet. I think there's much more work to be done, but I don't see enough people kind of calling this out. I see very few people expressing any regret over the merge, and I hear almost nobody saying that DeFi is shrinking. And it's not shrinking if you take account of the liquid staking, but that's just scorekeeping. I don't think that really counts. So one last point is that to the extent that this becomes centralized with one big mining pool and one critical software, it makes it way easier for the federal government to intervene. The reason that people like Bitcoin is that there's no way for the government to touch it or intervene. But to the extent that you have enormous concentration of power and single points of failure and so forth, relatively easy for the government to step in. And they certainly have already begun to go after the big staking pool operators to allege that they are selling securities, to say that they need to comply. And there's a lot of legal controversy to be settled out. But if you don't want the regulators, I think you need to reconsider a lot of this market design.